Okay, hello everyone. So in this video, we'll be talking about daily range and displacement range. Now, what are daily range? Daily range is your high and low in your chart, in your recent chart. Now, you don't want to be clouding up your chart like this. This will be too tight. You understand? Sorry, there's network. So you want to make sure you're putting your chart in a visible manner where you can see both the high and low. So when you toggle your to anchor it to that top to this low, this is your daily range. You understand? So the purpose of doing this is to know what your premium and discount zone. So talking about displacement range. What are displacement range? Displacement range are aggressive price action move over structure. You understand? Meaning price displaced off a price leg. So let's say aggressive price action move over structure. Take note of that. That's the definition of a displacement range. So aggressive price action move over structure. This is structure and this is also structure. This is an aggressive price action move. That is a displacement range. You understand? So you also treat it as your buy, as your premium and discount. So see price went back to the discount before going higher. This also another displacement range. You understand? Aggressive price action move over structure. So that's just the difference between your daily range and your displacement range. Mostly you find your displacement range in your daily range. You understand? So it can also be down. This is also a displacement range. Aggressive price action move below structure. You understand? That's also a displacement range. Also treat it as your premium and discount. So you want to take note of that. So that's a simple difference between your daily range and your displacement range. Thank you. Okay, in this video, we'll be talking on the BC and CB. Now, what's BC is an acronym for buy side imbalance, sell side inefficiency. Buy side imbalance, sell side inefficiency. So the BC is your fair value gap, whereby when price is going higher, you understand? The fair value gap that form when price is going higher, that's a BC. So a CB is when price is going lower and the fair value gap in between that. That's a CB. You understand? This is sell side imbalance, buy side inefficiency. So what that means is sell side imbalance. No, for the BC, the buy side imbalance, the buy side is not balanced yet. You understand? The sell side inefficiency, meaning price has not given an efficient sell side. You understand? So when this occurs, it's already given a sell side efficiency like that. You understand? When this occurs, passing through this, it's already broken this BC like that. So for this CB, which is sell side imbalance, buy side inefficiency. So the sell side is imbalance, then the buy side is inefficient. So meaning we need a buy candle to pass through this CB, which does not, price hasn't done that yet. As you can see, if we move to the right hand side, price hasn't passed through this CB. So this CB is still intact, but this is no more intact. The BC is no more intact because we already have the sell side inefficiency given already. So all this fair value gap, the sell-side inefficiency has been given by this price leg that fell, that broke down. So which will be your displacement range. You understand? The sell-side inefficiency has been given. So we have buy-side imbalance, sell-side inefficiency, but this inefficiency has been given with this candle, leaving another buy-side imbalance. That is B high, the B high at the end, the buy-side imbalance, sell-side, buy-side inefficiency, sorry, sell-side imbalance. So we need to take note of that. So we just need a buy-side efficiency to break this CB. So that's all you need to know about your BC and your CB. Your CB is when the trade is going down, and your BC is when the trade is going up. The fair value gap that form in between those movements. So this is also your CB. You understand? And okay, and this is your BC. So that's all you need to know about this. Thank you. Okay, so in this chapter we'll be talking on the intermediate term low. So what's an intermediate term low? Is where you're having a short term low at the left and a short term low at the right. The low that went below all those lows, below the two lows, is called an intermediate term low. So this is for an uptrend. That's why. So from uptrend you have at least a small pullback. So that pullback is called a short term low. So if another pullback that is greater than this happen, you understand, you call that an intermediate term low, but it's confirmed an intermediate term low when there's also another short term low that didn't break this low. You understand? Intermediate term low. Why is it short term low? Short term low. So an intermediate term low is a low that have two short term, a short term low at the left and a short term low at the right. Then you see price going up. Remember, this is an uptrend. So if for a downtrend, it will be short term high. You understand? It will be high and short term high. The intermediate term high will be the one at the middle. You understand? Just inverse it. Now, how do you use this to enter a trade in order to increase your win rate? Because most time you'll notice some trade that you're taking, a market structure shift has taken place, then later on you still went on and break your high, taking your stop loss. Now how to avoid this is by looking for your intermediate term low and making sure that market break that low. So that's where you want the market structure shift to take place. This will also help you in not entering a trade so quick. Understand? It will help you in protecting your trade. So let's say normally if this is where market read the high, so you are looking for a low. Normally just take note of the recent low, right? And you want market structure to take place there before shift. But if you want to increase your win rate, don't just take note of any low. Take note of the intermediate term low. Look for an intermediate term low. You understand? So you look for a low that has two lows beside it that's not lower than that. Then if it's for downtrend, it will be highs. So we have a short term low here, we have a short term low here. So these are intermediate term low. Then we want price to break that structure before we actually look for our fair value gap, which is what happened. Yeah. You understand? This will also help you to escape inducement. So that's what you need to know about intermediate term low. Take note of that. Thank you. Okay, so in this video we'll be talking on understanding the equilibrium of discount and premium. So sometimes they call it the upper quarter and the lower quarter. You understand? So you know this is your discount and this is your premium. What you want to do is after taking your dealing range, which is I'm taking from this high to this low, you understand? Half it, that's the 50 mark, premium and discount. Now from year to year again, you want to cut it into half. So this will be your upper quarter for your premium and your lower quarter for your discount. Why are you doing this? Is to know if price have gotten to a deep premium for a sell or a deep discount for a buy. You understand? And also it can also give you where you should be taking profit. So if you are buying here and you're targeting the high, you should be careful when price gets to the equilibrium of the premium. You understand? You want to at least maybe take partials or get out of that trade. You understand? Because price will surely play with it, play around that area. You understand? Because it's a price leg, as you can see. So that is the usefulness of understanding the equilibrium of discount and premium. You understand? That's all. In this video, we want to talk on a quarter of week and why it's important. So, you know, when you have a long week like this, like I told you before, you want to take note of two things. First, the consequence encouragement and the quarter of that week. So, if you're expecting price to reverse, first you don't want price to close at the quarter of that week. That is on top of that, the can weeks can go through, but you don't want price to close at the top of the quarter. That will confirm a nice sell-off. Can you see? So if price close at the top, next you don't want price to close at the consequence encouragement of that week. If price ever close there, that means your sell trade should be invalidated. You should wait the price get out of that zone well before you actually look for your sell trade. As you can see it here, pricing close above the quarter of this week, which is what we're talking about today. Now the consequence encouragement from year to year is a consequence of the middle. Now the quarter of that too, the quarter of this week, which is this. As you can see, what price did here, it didn't close above that. You know, weak to the damage, but it tells a story. So it's just to trick people on how. So pricing closed above that, which is a good thing, before reversing, came back in again and before crashing down. So that's what you want to know about the quarter of the week. Take note of it when you have a long week like this. Now if we also see this, let's take off this. I say you should always take note of any week you see. Let's take note of this week. If you see a very long week, always try to. So we have this here. Okay, now if you see what price did, it broke the quarter, right? And price went to the consequence encouragement of that week, but never closed above it. You see, just touch and crash. So let's check this week. Now, see what price did? It didn't close at the quarter and didn't even get to the this thing. So this would be a nice sell-off, you see. The crash was well. So you don't take note of that. Always take note of the quarter of week. If price break any quarter of week, it's a bad sign that your trade might not go in play. Thank you. In this video, I want to talk about the inversion fair value gap, immediate rebalance, and implied fair value gap. So I'm starting with the inversion fair value gap. So inversion fair value gap, if you can see, we have a fair value gap here, right? The price went through it without leaving any fair value gap at this side. Can you see? Normally, if there was a fair value gap at this side and I extend this fair value gap with this fair value gap, that would be a balanced price range, right? But since there's no any fair value gap, if you extend this fair value gap to your right hand side, which is what I did, that's an inversion fair value gap. You see how price went there and came back. You understand? Aligned with this other block. Yeah, this other block. So that's also a nice entry you want to take. Now for the immediate imbalance, when you see price showing you an immediate imbalance, that's just to tell you that if your bias was bullish and you can see an immediate imbalance, then the price will actually go your way. It's just like a higher confirmation. So if like we're bullish and markets are expected to go higher and it does this type of formation, is one of the most powerful signature for immediate dynamic price delivery. So as you can see, price open here. That's why I list price open here. This candle. Then what happened? It went down immediate, took this high, and what? Like this is another block if you take note of it. So and pricing returned back to that place. Can you see? Pricing returned back to this leg, if you can see at all. So it immediately took, because price is rushing to go up. So after it opened at this point, it closed at this candle, opened at this candle, came down, take the high, and once it went up. That's all you need to know about an immediate rebalance. It's an immediate dynamic price delivery. The next thing I'll be talking about is my implied fair value gap. Now, what are implied fair value gap? You can simply say they are, when you have week and weeks, conjoined together, that's a volume imbalance, right? But now, when you have week and week that meet each other with bodies, with just a body, sorry, you understand? That is an implied fair value gap. You see this body, this is a week, this is a week, and this is a week. You see that you don't really see this type of formation well, but I think I can see one here too. See this week, then this body. You see how price came in there before going higher. That's also a fair value gap you want to take note of. It's an imbalance, but it's an advanced fair value gap with this. It's called an implied fair value gap. So you want to take note of three things: the implied fair value gap, your immediate imbalance, and your inversion fair value gap. Take note of that and write it, have it in your journal too. Thank you. Okay, so in this video, I want to talk about liquidity voids. What are liquidity voids? Real liquidity voids are periods in time when neither buyers or sellers were never given opportunities to book a trade. You understand? They are also called common gaps, meaning price just went through that. Mostly you find them doing news, those price legs. You understand? Up. That's what you want to call known as liquidity void. Price might likely still trade through such leg. in the future later. So, but they are mostly they are inefficiency too, but they are just common gaps. The gaps whereby they weren't giving buyers or seller opportunity to enter the market. So this is not your common your BC or CB. In this case, usually be CB, but this is not your CB or your fair value gaps. It's not your common CB or fair value gap. That is sell side imbalance, then or buy side inefficiency. Sell side imbalance, buy side inefficiency, or your fair value gaps too. Your CB and your fair value gaps price buyers were given opportunity at those time, but your volume, your liquidity void, sorry, or common gaps, also known as common gaps, buyers weren't given opportunity. You find them doing news. That's all you need to know about liquidity void. I just want to point to that. You also see it in the chat, and sometimes it's always having this, leaving this large range in the market. So you want to always take note of it on your chart. Thank you. So this will be a quick one. I want to talk about time destruction. Time destruction is not hard to know. It's just at that price action. You understand? Is a daily range is always irrelevant. Understand? Price in this daily range, this range from here to here, is always irrelevant. This is another time destruction. You understand? We simply are looking for price to maintain itself, then eventually break to the upside. You understand? We're just looking for price to maintain that range, then eventually break to the upside. Exactly. Did you too? Maintain that range and break to the upside. That's the definition of time distortion. It's just to like confuse you and get you all sweaty and shaky. Understand? We already have our other block here, so we're expecting price to get in here and look at how many leg it gave us. That's time destruction. It's always like a time of accumulation. Then time you just take note of the range, understand the daily range, and that's what you want to make sure price is dancing in that range. Then break to the upside, which is what our because this is what bullish order block, right? It's a bullish order block, so we expect price to go up and price break this high. So we expect price to get there for as a breaker block. Price got there, but you see this time destruction. You see how many candles? This is a 15-minute candles. So for a 15-minute chart, you see how long this takes. Just it's almost a period of accumulation. You understand? Consolidation to accumulate in the market. The market just consolidate all through before going higher. So this is the range, and what you just want is for eventually break to the upside. You see, price break to the upside. That's all you need to know about time destruction. It's all those funny candles that you see, how shaky and get you sweaty. Thank you.